For y'all don't know me, my name's Christopher Anderson, and I'm a partner in a small local CPA firm called Gammill, Boyd and Anderson, PA, which I don't know why they put my firm on there. But that's my contact information. And feel free, if you have any questions after this program, if you have any questions, to email or call me on anything to talk about, or if you have any other questions or anything. I don't charge if somebody calls and has some simple questions and stuff. But I've started doing research and things, I may charge some, but just for simple questions stuff, I don't charge. Now today, what we're mainly going to go over is I'm going to focus the first part on the new tax bill I passed, the one big beautiful bill, BBB bill that was passed July 4th, 2025. There's several key changes with individual tax returns, and then there's also some business changes. I probably won't go very much on the business stuff because I'm not sure if there's a lot of business owners and things in here, so I'm mainly going to focus on the individual side of these changes. Then here's kind of an overview of some of the key changes on the BBB. There's going to be an enhanced deduction for seniors. There's an increase in the SALT deduction for itemizers. That's state and local taxes that you can deduct if you itemize. There's a new above the line deduction for car loan interest. There's some changes to charitable contributions. Some of the changes are good, some of the changes are not good, and we'll go over that. I'll go quickly over no tax on tips and no tax on overtime. And then the last thing I'm going to cover on the BBB will be some of the energy credits that I discussed last year. They've all ended in 2025. So I'll kind of go over those real quickly. First item on the BBB is the enhanced deduction for seniors. A $6,000 deduction per taxpayer that's 65 years or older. There are income phase outs starting at $150,000 for married filing jointly, and then it's money phased out once you get above $250,000. And on that deduction, I know there was a lot of talk about being no tax on Social Security benefits. You still hear politicians every once in a while say that there's no tax on Social Security benefits. That's not true. Social Security benefits are still taxed like they were before the passing of the BBB. Congress debated about it, and then they decided to come up with this deduction instead of the no tax on Social Security benefits. So anytime you hear politicians say no tax on Social Security, that's not right. Then on the increase in the state and local tax deduction, this is again for itemized deduction deductors. Before the BBB, if you itemize your deductions, you can only deduct up to $10,000 of your state income tax or your real estate taxes or your personal property taxes, and anything above that, you just lost out on. But they passed this deduction and increased that up to $40,000. So that's going to allow more individuals to itemize their deduction. Now, there's also income phase outs on that, and the income phase outs, again, if it's over $500,000, then you lose out on $20,000, but under no circumstances will go below $10,000. So you'll still get $10,000 on your itemized deduction for those taxes, no matter what your income levels are. And again, you must itemize your federal deductions in order to take advantage of that. The other one is a deduction for car loan interest. This deduction is a above the line deduction, so you don't have to itemize your deductions in order to take advantage of this. And it's limited to $10,000 of interest that you pay on a new vehicle. It has to be a new vehicle, and the final assembly has to be done in the United States, so it can't be like a foreign vehicle. Again, it's above the line deduction, and and their income phase out, $200,000 when it starts, and then after you get about $250,000 on your MAGI, when you get no deduction at all. And MAGI, all that is your adjusted gross income plus any tax exempt interest. That's how that's coming. Now, some of the finance companies are going to supposedly provide like some kind of tax document or some kind of documentation that's going to tell the taxpayers how much interest they pay. And then you also want to make sure to put the VIN number in there because the form of claimant deduction requires the vehicle's VIN number in order to claim. Next one here, and I'm just going to go over this real quick because I'm not sure if anybody's it works on tips, and I'm not sure about overtime, but they did pass a rule where they're not taxing tips of up to $25,000, and that's whether you file single or whether you file married jointly. It's limited at $25,000 per return. And that will, that helps out a lot of those restaurant servers, different people like that. Again, there's income limits on that. The other one is no tax on overtime. And on overtime, it's limited to $12,500 per taxpayer. So if you file jointly, it's $25,000 limit. And on the non-taxable portion, it's only the portion that's the half portion in time and a half on overtime that's not subject to tax. So, for example, if you get paid $10 an hour, okay, time and a half of that is $15 an hour. So it's the $5 that's not subject to tax. All the remaining amounts are still subject to your ordinary income taxes. There's only certain industries that are eligible for this. Mainly restaurants are the only ones. There is, I think, like barbershops, some of those places like that, I think, are eligible for it. But yeah, you can't just put somebody on tips or put it in it else. It don't work that way. No, like I said, that's that's going to help out some of the, again, people working in restaurants, things of that nature. They have to work a lot of hours and get tips and everything. So that's going to help them out quite a bit. Again, somebody works 41 hours. Okay, you got 1 hour of overtime. You're paying them $10 an hour. That pay's got to be $15 an hour. So 15 minus 10, $5. That's all they get.
Yeah.
There's always catch for any of these. It always sounds better than what it really is.
That's fine.
Okay, next thing is some of the changes on donation. Again, there's some positive changes on this, and there's some that are not very positive. One thing that they're allowing, and this all starts in 2026 on this one. They're allowing an above the line deduction for people that don't itemize to get $1,000 deduction if you're single, $2,000 if you're a joint return. They'll give me a little bit there if you don't itemize. On that one, you have to donate cash. It has to be cash or a right check or a credit card. It can't be like property you donate. I don't know if this really applies, but there was a what do you call it? The DFAs, the donor advised funds. Any money you put in there, you can't use for that particular deduction. So that's the positive news. The negative news on this is that they've got now a floor on how much you can claim as a charitable donation, and the floor is 0.5% of your AGI. So, for example, let's say your AGI is $100,000. 0.5% of $100,000 is $500. So you have to go above the $500 before you start getting any kind of deduction on it. So if you donate $1,000, you're only going to get a deduction of $500. One of the rules, I think what they did was they gave this because that's going to cost a lot of revenue, so they take away that to try to offset it. And then another thing here that I don't even have on this slide, and I don't know if it applies to a lot of people, but some. If you are in the top marginal tax bracket, which is 37%, okay? If you are in that bracket and you do donation, your effective tax savings is not 37%, it's 35%. So they knock off 2% on your tax savings on contributions. I get an example of that. Okay, you donate $1,000, let's say, and before this rule, your actual true tax savings on $1,000 is $370. That's under the old rules. It's considered your 37% marginal tax bracket. Under the new rules, you'll still be at the 37% tax bracket, but your effective tax savings now is around $350. So you're losing $20 on that because of this new rule change. Again, a a lot of stuff sounds too good to be true sometimes, and they sometimes give you somewhere and they take it away somewhere else. Okay, last thing on the BBB, it in the energy credits. I talked a lot about these last year because they were pretty good tax credits, but they ended it at the end of 25, so those are not really any long. They're no longer available. Almost all of them. There's a few, but not very many. But really, the big one that we talked about was the what's called a residential clean energy credit, which I call the solar panel credit. And it was 30% credit on the cost of putting in a solar panel to your house and everything. Of course, that's gone. Now, that credit was what you call a non-refundable credit. So any excess you had that you didn't use, you got to carry over. You still get to keep the carryover on that. So anybody that bought solar panels in 25, 24, or whenever, and they didn't use all of it, they got carried forward, you'll still get to keep that. You won't lose that. Anybody that puts solar panels in 2026, that credit's gone, so you're not going to get any credit on that anymore. And that's going to be the major individual things on the BBB. Anybody have any questions on anything with that new bill? Again, there's some other things that it's done, but they're kind of smaller things that don't really have time to really go into deep and everything. But there's some pretty big changes on there, and it does help a lot of individuals, especially people that are considered middle income to lower income. There's quite a bit of tax savings there on that. The only thing that wasn't really retroactive that I went over was those charitable contributions. That's going to take effect in 2026. So that won't show up until you do your tax returns in 2027. So the old rules for charitable contributions are still there for the tax returns you do this year. So there don't be that above the line deduction. That won't be on there for charitable contributions in 25. It starts in 26. Okay. The next few topics I'm going through is just going to go over some areas I think are pretty important that will, maybe help y'all guys with some tax savings, some different things like that. Some of these items I've talked about in previous presentation, but again, I think they're very important, and I think you've got to get a lot of information on these, and it's good to have a little refresher on some of this stuff. This slide here shows the retirement contributions, 401ks. It shows the 2025 amounts and then the 2026 amounts. And then, of course, if you're 50 or over, you get a catch-up amount to your 401k. And then there's another thing that I just found out fairly recently that I wasn't aware of is that, and correct me if I'm wrong, if you are age 60 to 63, they have what you call a super max catch-up. So you can actually contribute, like for instance, 2026, that's the normal one for somebody that's under 50. But if you're between the age of 60 and 63, so you can put additional $11,250 in there. I wasn't aware of that till this probably when I was actually researching this. So that's good for somebody at 60 to 63. They can put a little bit more in there. And of course, the 401ks, you got your pre-tax, and then you got your Roth. Most of them have a Roth feature in it. And then another thing that I found out about too, this is kind of something that's new. I think it was passed with that Secure Act 2.0. But anybody that's considered a high earner, which is $150,000, that's for a previous year, they go back to let's say 2025, and your W-2 is, let's say, $150,000 more, or your earnings are $150,000 more. The catch-up portion of your 401k contribution has to go into a Roth portion of your 401k. You can't put that catch-up version into your traditional portion of your 401k. And like I said, I think most 401ks offer Roth now, but there's still a few plans out there that don't. And unfortunately, if you're in a 401k plan that doesn't offer the Roth version, then you're out of luck on doing the catch up. That's something they changed with that Secure Act. All right, this slide here this is your IRAs, Roth and traditional. There's the amount that you put 2026 for under 50, and then there's the amount for over 50s. And just a couple things. In order to contribute to an IRA, you have to have earned income, which earned income is really your W-2s. If you're self-employed, income of that nature. Really, it's income that you pay Social Security and Medicare tax on. So you have to have that. Now, some taxpayers I know will have, let's say that the taxpayer, works and the spouse stays at home and doesn't work, or, stay at home mom or something. That the spouse can actually borrow the earnings from the taxpayer and are able to go ahead and make the IRA contribution, even if they don't really technically have earnings or earned income themselves, but they can borrow from their husband or wife and still be able to do the contribution to an IRA. And then again on IRAs, as y'all probably know, there's income limits on that, and it all depends on a traditional IRA. It depends on whether you're covered by an employer plan. Like if you're covered by a 401k, then there's limits to how much you can put in there that's considered deductible. And if we're single, if you're over 81,000 in AGI, it starts lowering down the deductible amount. And then once you get over 91,000, then none of it's considered deductible. Married filing jointly, it's 129, and then once you get over 149, none of the traditional IRA contributions are deductible. Your tax covered. And the Roth, of course, Roth is after tax, so you don't get any tax deduction on a Roth contribution. But there's also income limits on Roths to be able to even put money into a Roth, and those income limits are 153 to 168 for single. So for 153, it starts phasing down. You get over 168, you get nothing. You can't put anything in there. And then on married filing jointly, it's 242,000 to 252,000. Like I said, once you get for 252, you can no longer put any money into a Roth. Now, I don't have this anywhere on here, but there's a feature, and you might know a little bit about this yourself, where you can kind of circumvent this a little bit. What you can do is what they call a backdoor Roth IRA contribution. And how that works is the traditional IRA does not have an income limit to how much you can put in there. Now, you can't deduct, but you can put what you call a non-deductible IRA contribution up there to the maximum amounts. So if your income's high, like I said, you won't get a tax deduction, but you'll still be able to put money into a traditional IRA. And what you can do, correct me if I'm wrong, is that once you do that, then you can convert that traditional IRA contribution into a Roth IRA contribution. That way there, you can still put money in a Roth by doing that conversion while still being over the income level.
You just have to pay taxes on it.
Yeah, you have to pay tax. Yeah, you have to pay taxes on it. Yeah. And see, if you do if you put money into an IRA, traditional IRA, it's non-deductible. You're already paying tax on it because you're not able to deduct it. So you're paying tax with it anyhow.
Yeah, non-deductible.
Yeah.
Non-deductible.
Non-deductible IRA, you can move it over to the Roth and kind of circumvent that rule. Yeah, they encourage you to retire, but they also want their tax money. So there's a fine balancing act there.
They want you to set aside for retirement, but not too much.
Not too much. And that's one of the things, if you'll notice, I don't know if you have or not, but there's a lot of focus, you hear stuff from the government stuff, about putting money into Roths. That's one of the big things that they really try to push now. And there's good reason for that, because, you put money in a Roth, it grows tax-free. So the earnings on that Roth, whenever you're ready to pull it out, never get hit subject to tax. So you got actual true tax-free income. Okay, that's a good thing, especially when you have something, if you're young, you're 20s, when you get 70 years old and you're ready to retire, you're going to have a lot of money in there, assuming that you continue to contribute to it. That's going to be totally tax-free. And then there's there's no R&D requirements for the benefit or for the owner of the Roth or their spouse. So there's a lot of good things about that. But the main reason the government focuses on that is because they want your money now and don't want to wait later on when you pull the money out for retirement.
So I'm a big proponent of Roths.
Yeah.
I always have been. And then they came out with these rules, and I was like, oh, I don't. And now I'm being a proponent of what the government is pushing now. Now it makes me nervous. But it is still a good thing. They just want their taxes now.
They want their money now instead of later.
But I'm afraid 30, 40 years from now, they're going to have a problem.
It could be. And what you always got to watch out for is that no matter what's in tax law, it can always be changed. There's stuff in here that they say is permanent. Doesn't necessarily mean it's permanent. They can always change that law and everything. And one of the things I've heard about, and it isn't from some of these far off people that come up with these conspiracies and stuff, is that what they're going to do is have everybody put everything in a Roth and then eventually come up with some kind of tax where they tax these Roth accounts a one-time tax on these Roths. So they're wanting everybody to build up these Roth accounts, and then, I don't know, 20, 30 years from now or whenever, you're going to come up with a one-time tax on that. And I've been hearing that for years. I don't know if that'll ever happen, but that's
So it just so happens.
yeah.
I think you're going to have to at some point, but I won't be here and you won't be here to.
Yeah, you will be.
The youth movement in our office has talked me into, he and I did a podcast on Roth.
Okay.
So I don't know, where do they find it at?
It's on YouTube.
Sweet.
YouTube, there you go, go to YouTube.
I'll be out the greener city.
Yeah.
What do you search on there to find it?
Stree posted it.
So it's the video is called Leave a Legacy Raw. So the podcast series that we were doing at the time was Leaving a Legacy. And it was episode 2, and it's about Roths.
Yeah. So we go over not just contributing to a Roth for young people, but also what Roth conversions would look like for someone who may be between retirement age and drawing Social Security, or retirement age and RMDs. And the reason that we do that is because traditional dollars have the required minimum distributions. And also, whenever you pass them on, they have to be zeroed out within 10 years. Roths, while they still have to be spent within 10 years, pass tax-free on to your heirs and your beneficiaries. And so we talk about leaving a legacy, not just the potential tax savings of converting to a Roth, but also the potential tax savings for your beneficiaries and not just yourself. And we go over all that in really great detail in our podcast if you guys want to listen to it.
If you guys follow us on Facebook, I'll make sure to share it on our Facebook this week.
Yeah, because I have several clients that they have, they used to put money into a traditional account. When I started, that's all you talked about, put stuff in traditional and everything. There wasn't a whole lot going on about these Roths. I don't think there was Roth 401ks when I first started. You had the Roth IRAs, but they had just started everything. But I have a lot of clients who, have these big accounts, and they're never going to really need to touch them. I mean, they're high earning. They've got real estate investments and things like that, and they don't really ever need to touch them. So it's really nice to have that Roth to be able to give to your heirs, and they get this money. And again, like you said, they have to pull it out within 10 years of the death of the beneficiary or the owner or the spouse, but they get all this money tax free. The older you get, there are probably some tax savings, but it may not be quite as much as it would be. And one thing about a Roth is once you contribute to it, if you never have contributed to a Roth before, okay, when you contribute to the Roth, it has to sit there 5 years before you can start pulling money out and it being totally tax free. Am I correct on that? Correct.
The interest, you can pull out the,
You can pull out the principal portion of it,
Yeah.
but the earnings and stuff, if you pull out the earnings portion, that part's going to be subject to tax if it's less than 5 years. So, and then again, when you convert money over from a traditional to a Roth, that's a taxable event. So your age, if your income is a certain level, you pick all that income up, okay, well, that's going to cause maybe your Social Security benefits to be subject to tax more. And we'll go over this here in a little bit. I'm getting ready to go to that, but your Social Security will be taxed more, up to 85%. If you're a hiring individual, maybe you're right on that border on your Medicare premiums, where they have what they call an IRMMA, which is an income related monthly adjustment on your Medicare premiums. Your Medicare premiums a month could be substantially higher because of your income from 2 years ago. But so you got to really be careful about that, and that's why you want to make sure you have a really good tax professional or Brad or whoever to run those numbers for you and make sure that that's going to be beneficial for you, not only in the short term but long term too. You got to be careful about it. I said again, you have to watch out your income levels because, again, when you convert that over, that's a taxable event. If you put $50,000 from a traditional and move it over to a Roth, $50,000 of extra income that you're not actually getting, it's going into an account that has to be there for 5 years for you to be able to take advantage of it to begin with. Be careful. So, all right, go on the RMDs. Like I said, I talked about this. Most of y'all probably already know this stuff, but I got the age up to 73. So once you turn 73, you got to start pulling money out of your traditional 401ks or traditional IRAs. On the first year, you have till April 15th of the following year to do that distribution. If you turn 73, like if you turn 73 and 70 and two, if you turn 73 in 2025, you have till April 15th of 2026 to take your first RMD. You got to be careful about that because if you do that, then you're going to have to take 2 RMDs, the one to cover 25 and the one to cover 26. And again, you want to try to keep your income as low as possible. That raises it up. It can cause you to lose out on a lot of these deductions we talked about, and it can hit you on your Social Security benefits and hit you on your Medicare premiums. And one other thing is, they got legislation that age is supposed to go up to 75 by 2033. This next topic here, this is one that's very interesting to me that I think more taxpayers will take advantage of it, and I just can't seem to get people to do it. But they got what they call a qualified charitable distribution. What that is that especially somebody that has to pull out RMDs. Okay, let's say you don't really need the income, but you have to pull out your RMDs. But what you can do is instead of pulling that money out, you can donate that RMD or any distribution amount up to a certain amount to a charitable organization. That way there, you don't have to recognize that income. You give a contribution to whatever charity, church, whatever it is that you're wanting to help, and it's a win-win situation. And it satisfies your R&D. Now you can do that up to $108,000 per taxpayer. So if you're doing a joint return, that's $216,000 that you could pull from a traditional IRA and put into a charitable contribution, make a charitable contribution with it, and don't have to pay income tax on that. Now there's some catches on that. You can't take the money out of your IRA and then write a check and give it to the charitable contribution. It has to be a direct trustee. So whoever's trustee of your 401k or IRA, they have to directly send it over to the charitable foundation in order for that to work. And then again, you can't double dip, can't not recognize the income and also get a charitable donation. It don't work that way. So basically that's a good way to lower that income. Keep that income lower. So that's your Social Security gets taxed. Will possibly help you from avoiding any kind of Medicare charges. That's kind of what that slide talks about there. Just talking about income control using these UCDs. Next couple of slides, I'm just going to kind of go over some Social Security issues and Medicare. On Social Security 2026, there was a 2.8% increase in your Social Security benefits. I think on average, that's averaged about $56 a month increase. That's all that really is. And then if you'll notice, your Medicare premiums went up from standard, went up from 185 to $202.96. So really, 2.8% cost of living adjustment plus the Medicare increase, you're only getting about $38 more a month extra on your Social Security. Then quickly here on the taxability of Social Security benefits, I kind of explain to you guys how that works. How it works is this, okay? They got what you call a provisional income threshold, and that's 25,000 if you're single, 32,000 if you're joint. And now what provisional income is it's all your income except for Social Security, AGI less not Social Security, all your income, your taxes and interest, and then whatever your total annual Social Security benefits were. After that, add all that together. If it exceeds these two numbers, then your Social Security starts getting hit with tax. And up to 85% of your Social Security could be subject to tax. So you always have 15% that won't be subject to tax. Of course, Arkansas and Oklahoma, they don't tax Social Security at all, but this is just going to be on the federal. See if I got that written down here. Just kind of let you know, if your provisional income is over 32,000 but less than 44,000, then up to 50% of your Social Security was subject to tax. Once it gets over to 44,000, then it can be up to 85%. So it's not a big amount, and then you start getting hit with Social Security tax on Social Security. And then this is here. It's again about income control. And I'm talking about this is on that Medicare surcharge. It's called a income-related monthly adjustment amount. And what that is like, for example, 2026. What they look at is they'll look at your 2024 tax return. And if your MAGI is above a certain level, then they will start charging an extra amount monthly for your Medicare premiums. And that extra amount can be, let's see here, if I got that written down. It could be anywhere from $81.20 extra on top of the 202, all the way up to the additional $690. So it can be a pretty big amount depending on how high your income is. Now, the 690 amount, I mean, you're going to have probably your AGI is going to have to be over $750,000 for you to hit that top amount. But anything over 218, you start getting hit at a higher amount. So that's why it's very important to try to keep your income, down, because it can come back and get you later on. One thing you got to watch out for also is anybody goes to casinos or anything like that. Let's say you sell some business property, one-time income, okay? And what it is it's based off your gross income. So, for instance, the gambling, for example, if you hit a jackpot, let's say you hit a $500,000 jackpot, I know it's not going to happen. Let's say you do, okay? Let's say you spent $750,000 at the casino to win that $500,000, okay? Your gambling losses are considered an itemized deduction, so you have to be able to itemize, but you would be able to spend $750,000. The problem is when they come up with this Medicare surcharge, they look at adjusted gross income, which is income before you're able to take your itemized deductions. So if somebody hits a jackpot like that, they're going to have to pay an additional Medicare based off that $500,000 jackpot, when in reality they didn't really win that. And I've had a couple of clients that's done before, and we've tried to file an appeal on that. Trying to explain that, hey, You know, this is not really their true income. They've really spent this much and they disallowed it. There is another way to kind of get around that, but that's a different topic. But there is a way. And the same thing with sell property. You know, just say have a big, huge gain on some real estate, you sell stuff. And it's just a one-time income, just that 1 year. Well, then 2 years down the road, you're going to be paying Medicare premiums out the roof for income that you only got one time 2 years ago. So that's why it's very important to try to keep that income, manageable. But I never tell anybody, if you can get income, get it. But at the same time, there's certain techniques you can do to try to minimize taxes with that. And then the last thing I'm going to go over, I'm just going to go over this really quick. I'm not sure if anybody's a business owners or anything. But the few things that were changed under the BBB, one of the things, a couple of things that are really good, but the one is the so-called bonus depreciation. And what bonus depreciation is normally when you purchase a fixed asset, you have to depreciate it based off of whatever class life the IRS says. For example, let's say this chair is $1,500. You got to depreciate that over 7 years. So basically take 1,500 divided by 7. That's how much deduction you get every year on that. But with bonus depreciation, it allows you to take the deduction all at once at the time that you acquire the asset and it's put in service. And that's 100%. Now, before the BBB, they were slowly eliminating that. And I think in 2026, you are only able to take, I believe, 40% as bonus depreciation. Well, now they've changed it. Now it's 100% bonus depreciation on anything, on any assets like that. Section 179, they kind of left that the same, just kind of adjusted it upward. It's $2,560,000. And it's kind of the same thing as bonus depreciation. The only difference really is bonus depreciation allows you to have a negative profit, while Section 179, you can only get your profit to zero. It don't let you get below the zero. And then the other key thing, and this is very important with somebody that's manufacturer, and this is one of the reasons why they put this in here, is that they're now allowing Section 179 expensing on real estate, but it has to be a manufacturing facility. It has to be a warehouse or a plant that produces something or manufactures or something. Because in the past, Section 179, you never could use that for real estate. Like, for instance, this building here, you could just take Section 179 on that. But if it's a manufacturer, they're allowing you to do that now. And the reason they're doing that is they're trying to get investments for manufacturers to come over here to the United States and invest and start manufacturing here in this country and instead of overseas. And the last thing on that is Arkansas. Arkansas follows different rules. Arkansas don't have bonus depreciation. I think Oklahoma does. I think they do. And in Section 179, I think it's the same. It may be a little less. Arkansas used to live in Section 179 to 25,000, but I think they've got it to where now it matches federal. But there's a few little differences on state. What that is there, okay. So the maximum amount of Section 179 expense you could take, it'll be 2026, is $2,560,000. So let's say you have $2,560,000 worth of these chairs. You can expense that all at once instead of depreciating out. Oh. Now, the second number here is $4,090,000. What that is they take all the assets that you buy in 1 year. Let's say you buy chairs, tables, cars, whatever. And if it's over this $4,090,000, what they do is they start phasing out this number. So that number will start going lower depending on how much higher that number goes. It's what that is, a phase out. Most of these tax deductions always have some kind of phase out, certain deductions and stuff, but that's what those numbers are there. Let's see. Okay. This here, this is effective for 2026. Again, it's a ban for business owners. Normally, when you pay somebody $600 or more for, say mowing the lawn or whatever, you have to issue what you call a 1099. Okay. Starting in 2026, they've bumped up that threshold. So starting in 2026, it's now $2,000 for payments to individuals in order to be required to issue a 1099. So that's a big improvement there. That's going to eliminate a lot of the extra 1099s that really don't need to be put out there and stuff. It's like when you sell, let's say you sell a business, okay, and that's totally off topic of what we got here, but it's very interesting. You got assets in this business that's been there forever, okay, and you sell those assets, okay, and you take depreciation on it. Well, that depreciation you took that you got a deduction on 15 years ago, the government's going to come back and say, hey, we gave you a deduction on that and we want that back. And what happens is they calculate whatever the gain is on the sale of the property. Let's say you have depreciation of $15,000 on an asset. Okay, you have such depreciation, $15,000. And let's say you sell it and you have a gain of $5,000. Okay? What the IRS is going to do is they're going to take that $5,000 gain, okay? That's normally considered capital gain, which is taxed at a lower rate, 15% or 20% if you're a high income person. What they're going to do, they're going to take that $5,000 and say, okay, that you had that $15,000 deduction as an ordinary deduction, we're going to tax this $5,000 gain at ordinary tax rates instead of the capital gains rates. It's kind of a complicated calculation, but that's basically what they do is they're just basically taking the gain instead of you get taxed at 15, 20%, you're getting taxed at 37%. That's what happens. With rare circumstances or very rare situations where somebody has a vehicle and they're using it 100% of the time in the business, there's always going to be personal use on it. So whenever you report a vehicle in a business, you want to be very careful about showing 100% business use. Unless you have a legitimate reason to say this is 100% business, it's not going to fly for the IRS. Now, I have clients all the time that will do that. Have they ever got audited? No. But I tell them, I said, if you do get audited, I've told you, I've warned you that, I'll stand by for you. I said, it's probably not going to hold up. So a lot of times whenever I do tax return, technically what you're supposed to do, you're supposed to keep track of your mileage. Total miles for the whole year. This is business mileage, this is regular mileage, and then whatever that percentage is how much I can deduct that year for the business, for the vehicle. That's fuel, depreciation, oil and gas, whatever on the vehicle. Normally what I do though, most people don't really keep track of it. And usually, we'll show, 80% business, 70% business, something like that. Technically you are supposed to keep a mileage log. So if you ever get audited by the IRS, you better have those mileage logs to justify what percentage is being used in the business. If it's vehicles, technically you're supposed to. It don't matter where most, now if you take the mileage, the standard mileage on vehicles, then you definitely have to then. But even if you don't take standard mileage, you're taking actual expensing, which you want to take actual expensing. If you're trading vehicles every 3 years or 5 years or so, then you want to do actual. Now, if you're going to have a vehicle and you're going to keep it for a bunch of years, then you may want to look at doing the mileage then, because once you choose, you can't go back. Like for instance, if you go actual, once that depreciation is gone, you're not going to have that deduction anymore, and you can't all of a sudden start taking mileage. I mean, you'll still get fuel and oil, stuff like that, but you'll lose out a big deduction. So usually on the actual cost on vehicles, it's up front, it's better for you. Long down the road, it's not. I'll tell you guys. Look at it, but you're supposed to keep track of your mileage, even for taking depreciation. You're supposed to keep track. The IRS can go back 3 years from the date you filed a tax return. If there's fraud or substantial income, then they can go back an additional 3 years. That's what I was. All right, do the last thing real quickly. This is qualified business income deduction. I've talked about this in previous years. This is for people that own S corporations or partnerships. You get basically get on your individual return, you get a 20% deduction off of your income on these S corporations and partnerships. There are some catches to it. If your income's really high and you're considered what they call a specified business, which is like an accounting firm or I think maybe even an investment firm, then there's floors they have and stuff, so you don't get the full 20%. And then that deduction's not available in Arkansas and Oklahoma. And that's really all I got.